The hot topic in real estate, mortgage interest rates going up. Let's find out why. Rates have been going up, and so we've got the mortgage guru here. My good friend Keith Murphy from Essex Mortgage is going to tell us all about what's going on in the markets. So, Keith, what is going on?
Well, you got the headline right. Rates are rising. They are going up. Not sure about the guru disclaimer, but we'll definitely supply some facts and data here to show the folks what is actually going on in the market, what is driving rates higher, and then put some perspective on things as far as where are we in the market and in a big picture, what kind of opportunities there are in front of us. Let me just kind of give a precursor to, what drives a mortgage rate up and down. When I'm doing my initial consults with clients, I always go into this. How do you think mortgage rates are driven? And I'd say the standard answer that most consumers and home buyers come back with is that the Federal Reserve or the President or the Department of Housing and Urban Development sets the rates. And then when I ask, okay, if that's what's driving the rate, how often does it change? And I would again say the standard answer is about, once a month. Some people think it's every 6 months, others think it's a year. But as you'll see here in a little bit, it changes pretty much every minute of every day while the bond markets are open. So what's driving rates? Let's start there. What's driving mortgage rates up and down is the buying and selling of mortgage-backed securities. Right. And the same thing goes for savings rates on savings bonds. Those are tied to the issuances of treasuries. That is a savings bond. So when economists, investors, hedge funds, mutual funds, endowment funds, individuals are fearful of economic uncertainty in the capital markets like the stock market, they tend to see their money flow into the bond market where they can park it, earn a safe return until they see a light at the end of the tunnel, a little more certainty economically speaking. Then they'll sell those low yielding holdings and move their money back to the stock market. Keyword, low yielding holdings. But
now those are considered low yielding because for two reasons, and a safer investment, because they're backed by mortgages that are pooled to make these mortgage-backed securities. And those mortgages are backed by real estate, meaning land and homes and commercial buildings as well, I'm assuming, but that's got its own different market. Is that right?
That is 100% right.
Okay.
And on top of that, there's also federally backed insurance to mitigate any loss should a loan default. So yeah, it's backed by the full faith of the United States government. It's considered, as good as a brick of gold. It's solid, but the valuation of those bonds do go up and down as more people buy them. Depending upon the amount of supply, prices go up. And when there's less demand or less buyers or increased supply, prices come down. And what most viewers probably don't understand is the interest rate or the yield on those securities is inverse of its price. So if prices go up, yields come down, and if prices come down, yields go up. So that context, the ebb and flow of capital and the supply and demand of the paper is truly what's driving interest rates. Now, when we get into, outlying areas of economic uncertainty like a pandemic, then the Federal Reserve and the Treasury Department will step in and they will start buying these securities themselves. And doing so keeps the prices up and keeps the yields low so that the borrowing cost is low. Even though the savings rate is low, the borrowing cost is low. And it drives more capital into the stock market because there's a point of diminishing returns with inflation. being, say, at 3%. If you're only yielding 1% on your bonds, you're really losing 2% on your money for that protection. So they want those monies to go to the equity markets. They want to keep the housing market strong by buying up those securities. Okay. Now, and this is where I'll switch to share screen and show some charts, but can I just interrupt you real quick and just kind of get from what you just said? My understanding is that in this pandemic year, a lot of the buyers of mortgage-backed securities are in fact institutional investors and big investors that way. But the biggest investor and purchaser of the mortgage-backed securities has been the federal government. Yes. And that is what has really fueled these interest rates staying low. It's almost as if there's a high demand for these things. I'll pay you more for these mortgage-backed securities and I'm going to get less. So I pay for more and I get less. It's like paying for the penthouse suite and getting the room next to the elevator for your privilege of your dollar. Yeah, no, that is a great analogy, the perfect analogy, kind of really. So yeah, to put some numbers on it, I mean, $120 billion of taxpayer money every month is being used just to purchase mortgage-backed securities.
Okay.
The government's also buying treasuries. Mm-hmm. They're buying corporate debt, even junk bond debt.
Oh, really?
Yeah, they're doing whatever they can to keep the capital markets liquid, keep those bond prices up, yields low. What changed?
Right, that's what we need to have. There's the subtlest little change. Yes. Here we go.
And the change is, I mean, you tell me, Kelly, in the day-to-day life compared to 1 year ago today, mm-hmm. Does it not seem as though things are starting to loosen up? Case counts of COVID are coming down. Yes. Businesses can operate a little bit more normally. Things are coming online. We've had the biggest, housing appreciation and sales in decades. And what does this cause? When economic activity picks up, right. When housing numbers are going up, when jobs are coming back online and people are getting stimulus, there's the key. Right. When people are getting their stimulus, they start buying more. And as they start buying more, what happens? Inflation happens. And as inflation goes up, and let's put some numbers on that. Lumber prices year over year, we need wood to build a house, are up 300%. Steel is up, I believe it's 180%. Copper is up like 240%. So all these raw materials, palladium, silver, they're all, except really for gold, because it's not used in building stuff, are up significantly. And there's also supply chain constriction where these products can't get to market to meet the demand. So higher production cost, less supply equals higher prices. And we're starting to see it. Oil went from the mid 30s to 60s in the last 6 months per barrel. Mm-hmm. Gas prices at the pump are now going up. So we have people losing their jobs, economy slowing down, a lot of uncertainty. And yet during that same period of time, all these commodity prices and food prices and energy prices are rising. So inflation, yes. That's what we're talking about. Right. Inflation hurts the bond market. So even though the Federal Reserve is stimulating the market, the bond market is looking forward and is seeing that no matter what they do with regards to saying that we're going to keep inflation in check, they really, according to the experts, not to me, I just listen to a lot of smart people, they have lost control of the yield curve. So even though they're buying this paper, the bond traders now are kind of switching out of bonds because inflation is going to erode the value of the money, and they're moving their money into the stock market which is why the stock market keeps going up, because these stimulus checks are going to create more economic activity, and more economic activity is going to create even more inflation, which is not going to be good for the value of our dollar or our bonds, which are basically the same thing. And so as the value of the dollar erodes, these bond values erode, and then your yield is gone. You could actually go in the negative really quick with rampant inflation. So the bond traders are liquidating and getting rid of their bond holdings. In this chart, as you can see, this is the 10-year Treasury note.
Okay,
and
the green one or the red one? Or just
it's the green.
This whole
green
thing
means,
that we're following.
Yeah, green means buying.
Okay.
And red means selling. So you can see it went from a lot of green over red to now it kind of switched to more red over green. And what this chart is showing, remember the prices are inverse. This is showing the yield of the bond. So as this yield has been going up since
third quarter of 20.
August of 2020 Q3, as you said. This was kind of the bottom. It was a double bottom set back in March. This was COVID.
Right.
When we found out about just how pervasive COVID might be and what it could do. And we went running scared, and thankfully we did, because it got those vaccines out. But there was a little bit of optimism, and then as the case counts rose, the market retested its bottom. But ever since here, it's been going straight up. And then you can see back in January, it gapped up. And the market at first thought, well, you know, it's going from a 0.9 to a 1.1%, which mathematically is an almost 20% increase.
Correct.
But this is the biggie. 6 straight weeks of bond prices going down, driving that 10-year Treasury note yield from, again, let's go to January, from under 1% to a 1.75% yield.
Double.
So almost double in 6 weeks. And that's the most selling of bonds that we've seen since the financial crisis in 2009. And I won't bore the viewers or you with more charts, but if you go back in time, the last time prior to 2009 that something like this happened was in the 1980s.
Oh, wow. I remember that period.
When the market crashed, everything got liquidated.
Yeah.
And
that's not to say I really don't think that we're going to see a crash again. And
I was referring to the stock market, by the way.
What's that?
I was referring to the stock market.
Right.
As far as when I say that word crash, I got to use that adjective cautiously.
Right. Because that is frighten a lot of people, and we're not here to frighten you. We're here to educate.
100%. Thank you for correcting me.
Yeah.
When I say crash, I was referring to the stock market back in the 1980s. Let's keep looking now. Well, where does this go forward from here? So we know mortgage rates are driven by the buying and selling of mortgage-backed securities. We know as prices go up, yields come down. But what is happening now is, even though the Fed is still buying about 60% of the market, these bond traders are taking their holdings and using it as an opportunity to sell back to the Fed. And now the supply-demand ratio is shifted.
Got it.
And right now we're seeing rates rising. So, you know, neither one of us and none of these market experts has any sort of crystal ball to know what the future is going to hold. But I think either one of two things are going to happen. Either A, our vaccination and lower case counts, regardless of spring breakers or whatnot, will stabilize, and the economic recovery, which we're seeing, will continue. And if the stock market's going to make, you know, if companies within the stock market are going to make more money, their stock prices are going to go up. You're not going to want to be stuck in these. I think if the economy keeps recovering, we're going to see these rates keep going higher. If there's a blip and case counts increase and there's a third wave and they want to lock down to protect people, well, then we could see the stock market sell off, and then that fear kicks in and the need for returns and certainty moves back into the bond market, and we see yields pull back. So I really don't know what is going to happen in the future, But here is what I do know. Right now, we've seen interest rates on mortgages go from, the lowest interest rates in the history of our country in the twos for a mortgage. Now they have risen from 2.5, 2.6, 2.7 on a 30-year to the low threes. And what I want to give some perspective on is...
And can I just say, as a banker, those are still fabulous rates for buying and financing real estate.
It's really free money, Kelly, because
it is.
If inflation's growing at 3% and you're borrowing at 3.25%, you're basically borrowing money for free and purchasing an asset that's appreciating in value. You're basically arbitraging money. And I know most people aren't buying houses for the financial gain. They're buying it for shelter and a place for future wealth building. But when the money's this cheap, it really is an arbitrage opportunity. What I have seen in my mortgage practice over the last 6 weeks is a little bit of shock and awe, where people were inquiring about a refinance or getting ready to make an offer on a house and calling me for a quote. And we were again quoting interest rates with no points in the mid twos and with some buy down cost, in the low twos. And then they call back, seemingly a month later, and it's like, what do you mean it's 3.2%? How could that be? Rates change once a month or once every 6 months or once a year. Who changed it? I'm like, well, you got to understand the context of what's driving this. But in the big picture, let's look at that. This chart from the St. Louis Federal Reserve only goes back to 1972.
And this is important that it's the St. Louis Federal Reserve for what reason? Is it because they're the ones who do all the tracking?
Well, Fannie Mae, Freddie Mac do charts. I just happen to like the Federal Reserve chart because most people realize that there's no interested party to show or skew any sort of numbers. This is just facts. So I always like to just go to the Federal Reserve chart. Now you can see that they leaned on Freddie Mac, which is part of our government, for the data. But if we go back to 1972, mortgage rates were at about 7.5%. And then throughout the 70s into the early 80s, they went up to 12%. They hit a high in 1981 of 18.63%. But this between this gap of 1978 and 1986, that decade was basically a bubble of inflation, eroding the value of the dollar and bond holdings, and that's why these yields went up. People were getting out of them because the inflation was eroding their value. But then, ever since then, we've been in a declining rate environment. But what I want to point out, it's so hard to see here. Hope the viewers can see this right here. At this end of this chart shows on December 31st rates at 2.67%, and then since then they've blipped up to here as of last week. So I just want people to see this gap. We're this much off the bottom. We're still at 3-something%, which we've only seen 3-something% one other time in our lifetimes, and it's now retested that. I don't know that we'll get back in the twos, but this is, again, free money, which means to me, if you're buying a home as an investment for the long term, for shelter, as a way to build wealth by paying down principal and realizing, long, steady, slow appreciation in value, it's still an incredible investment opportunity. And here's a fun fact for you, Kelly, and for anybody watching. When mortgage rates are at their norm, which over this period of time, the mean is about 7.5%. When you write your first check on your first mortgage to the bank that you get your mortgage from, when rates are at 7.5%, less than 10% of that payment goes to principal reduction or forced savings. The other 90% goes to interest. And then every single payment you make, a little bit more goes to principal and the rest goes to interest. But it takes years and years, like 15 years, halfway through the mortgage before you get to a point where 50% of your payments going to principal and the rest interest. Well, here's the home run fact. When rates are at 3.2% where they're at right now, over 41% of the very first payment goes to principal, not 10%, 41%. And then that number keeps compounding every single payment thereafter. So you are building equity much quicker than you normally could, because you're paying your debt down faster than you ever would have been able to on a percentage basis. Plus, the overall payment is lower because the rate's lower, and the overall interest cost is lower because the interest rate is lower. So if you're sitting on the fence as a renter or a move-up buyer, or even somebody who's looking to downsize, it doesn't really matter. Don't let this news headline that mortgage rates are increasing at a historical rate and the party's over, because it's not. This is still, as you said, Kelly, an incredible opportunity. And once we digest that this change is happening, we're going to see, more pent-up demand come to market with low inventory, which means we're still going to see these home prices continue to go up. Couple that with rising rents. They are going up. There's not enough supply. There's too many people looking for an apartment or a home to rent. And that makes up 2/3 of our working population that are renters. So as their rents keep going up and they see these low rates and they see the affordability, it's going to buoy these prices. People are mistaken if they think real estate prices are going down.
And I've heard that a lot lately. And people think, oh, the rates are going up, so the prices are going to go down, or we're going to see a crash, or we're in a bubble. And the truth of the matter is, we're not. There are the biggest population of wannabe home buyers is in the market right now, the millennials. And they want to buy, they want to own homes. A lot of them do want to rent because they're not sure where they're going to land. So there's a pent-up demand for housing for those people. So a lot of new homes are being purchased by investors, renting them to millennials. And then again, millennials are buying homes, new and resale. So a lot of folks we're seeing are keeping their homes off the market until more and more vaccinations are given, and then they'll feel safe to let people come in and be able to move on themselves. But that's another little part of that pent-up demand.
And we should do another story on this, Kelly, because I don't have my facts in front of me, but let me just piggyback on what you said with a big picture painting. If you take a look at the entire United States population of 315 to 320 million people, and you then segment it, how many are the baby boomers, millennials, Generation Y, Generation X. Don't hold me to this because, again, I don't have the facts in front of me, but it's something of this nature. The millennial generation has now doubled the housing demand, whether it's for rents or purchase. The housing demand is double from what the previous biggest buying group, which was the baby boomers.
Yes.
So their volume of purchase and need for housing is double what the baby boomer generation was. And they're stating that as Generation X, Y come online, so these are children between the ages of 7 and 8 to 16 right now, in 15, 20 years, they will be the next millennial group, and that demand is going to double the millennial demand. So we're going to see a quadruple demand on housing over the next 20 years when compared to the previous biggest generation shift, which was the baby boomers. So when you start looking at those demographic trends and shifts of actual people and age groups, and what they're going to need as they graduate from college and want to move out of their dorm room and not back to their parents' house, or somebody who's in their early 20s who's now got a secure job and is moving out of their parents' basement, they are going to get apartments, houses, or purchased. And that demand is like a freight train. It's coming, and that is going to continue, in my opinion at least, to over the long term, which is what I focus on, not the day to day,
Yes.
year over year, but decade over decade, it's going to fuel higher real estate prices. And so if you can buy in the market now, even though it seems like a top, it's not. And if you can finance it at 3 anything percent, for God's sakes, 4 anything percent, you're mathematically going to be so much further ahead than if you try to time the market and wait for lower prices, which probably aren't coming, or wait for interest rates to go higher, and then you've messed up the model that we just kind of explained here. So still reasons for optimism and positivity in this market. We just have to adapt that right now things have shifted a little bit and it's still good. And right now people are in a reactionary state because they think the sky might be falling because the rates went from 2.7 to 3.2. Big deal. That's how you have to look at it. Big deal. It's still a huge opportunity, and one that shouldn't be taken lightly, in my opinion, not because we sell real estate.
Right.
We believe in the sale of real estate and what it does for families, but I'm doing it to give people some paradigm shifts here. Step back from the headlines, look at what this can do for yourself. Sit down with someone like me or someone else that you know that does mortgages and look at, hey, if I bought a house back at 7.5 or had a mortgage at 17.5 or 4, what would the overall cost be? What would the overall monthly payment be compared to today at 3.2? And you'll see it's hundreds of thousands of dollars in savings or opportunity, depending on how you want to look at it.
So whether you're ready to buy a house now, or you own a home now and you've thought about refinancing, I think the bottom line here is that we want to temper people's fears and upset and just be educational and inform you so that you know what the facts are and you can be at peace with things and make a decision based on your needs and your family's considerations. So that's the bottom line here. Stay informed.